By the time the confrontation reaches this stage, the mistake is assuming there will be a decisive moment, a summit, a declaration, a collapse. But systems like this do not end with punctuation. They erode, they rebalance, they drift until the old assumptions no longer function. And by the time that realization becomes widespread, the transition is already complete. This is why the most consequential phase unfolds quietly. The shift toward a multipolar financial environment does not require the dollar to fail, nor does it require China to replace it outright. That framing misunderstands how dominance actually fades. Power anchored in confidence weakens not through shock, but through alternatives becoming acceptable. For decades, the dollar's role was not merely dominant, it was default. Trade was settled in dollars because there was no serious alternative. Reserves were held in dollars because safety was unquestioned. Sanctions worked because access was binary. You were inside the system, or you were not. That binary condition is what enforcement depended on. What is changing now is not the existence of the system, but the exclusivity of it. As energy enforcement, sanctions, and logistics pressure become more frequent, more visible, and more openly tied to geopolitical objectives, actors across the global economy begin adjusting behavior. Not dramatically, prudently. Central banks diversify reserves at the margin. Corporations renegotiate settlement terms. Commodity contracts quietly include alternative currency clauses. None of this attracts headlines, but collectively, it reshapes the terrain. This is where the endgame takes form, not as a confrontation between states, but as a reallocation of trust. China's strategy is not to replace the dollar as a global anchor overnight. That would be destabilizing and unnecessary. The objective is narrower and far more achievable. Reduce vulnerability to unilateral pressure and ensure that no single choke point can threaten systemic stability. Multipolarity in finance is not about dominance. It is about optionality. And optionality changes behavior. Once alternatives exist, enforcement loses certainty. Sanctions still bite, but they bite unevenly. Pressure still works, but it takes longer and costs more. Every additional tool deployed produces diminishing returns. This is the moment where the initiating power discovers that its leverage has a half-life. The United States still holds immense advantages. Deep capital markets, legal infrastructure, military reach, none of that disappears. But what changes is the cost curve. Each action requires more effort to achieve the same effect. Each escalation produces more unintended consequences, and each consequence feeds back into the fiscal and financial structure supporting that power. This is where strain accumulates. Military commitments remain high. Enforcement obligations expand. Interest costs rise as debt grows. Political constraints limit adjustment. Markets begin pricing not collapse, but persistence, persistent deficits, persistent issuance, persistent reliance on capital inflows. This is not a crisis dynamic, it is an endurance dynamic. And endurance favors those willing to move slowly. China's patience is strategic, not cultural. It understands that financial systems reward consistency over force. Credibility compounds. Trust accumulates. Each year that trade settles successfully outside the dollar without disruption makes the next transaction easier. Each bond held and rolled over in an alternative currency reduces psychological dependence. The shift becomes self-reinforcing. At the same time, global actors learn from observation. They watch how pressure is applied and how responses are structured. They internalize the lesson that neutrality requires insulation. Countries that once assumed alignment guaranteed access begin diversifying quietly, not to oppose, but to hedge. This is the most destabilizing outcome for a unipolar system. Not rebellion, but quiet adjustment. What breaks first is not the dollar, it is the assumption that it is irreplaceable. Once that assumption weakens, behavior changes. And when behavior changes at scale, the system follows. Energy markets adapt. Financial markets reprice risk. Alliances become more transactional. The cost of enforcing rules rises while compliance becomes less automatic. None of this happens abruptly. But it happens continuously. This is why the original trigger matters. The action against Venezuelan oil did not create these dynamics. It accelerated them. It provided a real-world demonstration that access can be conditioned, flows can be disrupted, and economic pressure can be applied indirectly. Once that demonstration occurs, it cannot be unseen. The irony is that the demonstration works too well. By showing how effective physical control remains, it incentivizes financial escape. By enforcing rules through dominance, it encourages alternatives. And by relying on power projection, it exposes the financial underpinnings that make that projection possible. This is the trade-off now in motion. For China, the path forward is clear. Continue strengthening financial credibility, expand settlement options, accumulate real assets, allow markets to do the work of reallocation. Avoid confrontation. Let incentives speak. For the United States, the path is more constrained. Reduce enforcement and accept dilution of influence, or maintain enforcement and absorb rising costs. Neither option restores the old equilibrium. The choice is not between dominance and decline. It is between adaptation and overextension. This is the reality few want to acknowledge. The system is not breaking, it is rebalancing, and rebalancing does not favor those who move last. The confrontation that began with oil ends with confidence, not because currency is more powerful than force, but because force is expensive and confidence is scalable. Once trust begins to migrate, it does not require coordination. It spreads through imitation. That is the endgame now unfolding. Not collapse, not victory, but diffusion. Power becomes harder to concentrate. Leverage becomes harder to sustain. Influence becomes more conditional. The world does not flip to a new order. It drifts into one. And when historians look back, they will not point to a single moment. They will point to a series of decisions that seemed rational in isolation and costly in aggregate. The oil squeeze was one of those decisions, not because it failed, but because it worked. It worked well enough to change behavior. And once behavior changes, systems follow. That is how this ends. Not with an announcement, but with an adjustment that no one can reverse without paying a price they are no longer willing to pay. These technical constraints are rarely discussed in public commentary, but they matter enormously. Energy systems are not plug and play. They are optimized over years. Disrupt that optimization and costs ripple outward through entire industrial chains. From China's perspective, this was not an inconvenience. It was a warning. That warning carried a clear message. Physical supply chains that move by sea remain vulnerable to American power projection. This is not a new realization in Beijing, but it is one that becomes more urgent each time it is demonstrated. The United States possesses unmatched naval reach and an unparalleled ability to enforce compliance across oceans. China knows this. It also knows that responding symmetrically would be slow, expensive, and dangerously escalatory. So it does not respond symmetrically. It looks for asymmetry. This is the inflection point most people miss. The assumption is that pressure invites retaliation in the same domain, ships for ships, sanctions for sanctions, but that is not how great powers adapt under constraint. When physical routes are threatened, the response does not come at sea. It comes through finance, through currency, through markets. The move against Venezuelan oil exposed a vulnerability that cannot be ignored. It demonstrated that discounted energy secured through geopolitical isolation can be interrupted by geopolitical enforcement. And once that realization sets in, the logic shifts. The question is no longer how to defend a single supply stream, but how to reduce exposure to a system where access itself can be denied. This is why the situation escalates beyond oil so quickly. Energy is the trigger, not the endpoint. As Venezuelan exports choke off, global oil markets begin to reprice risk. Volatility increases. Traders factor in geopolitical premiums. Futures curves adjust. These price movements feed directly into inflation expectations, interest rate assumptions, and broader market sentiment. A regional enforcement action begins influencing asset prices far beyond Latin America. At the same time, enforcement becomes more complex. Shadow fleets expand. Ships change flags. Ownership structures fragment through shell entities. Tankers repaint hull markings and alter registries to exploit jurisdictional gaps. Each maneuver raises the risk of miscalculation, a wrong boarding, a misidentified vessel, a diplomatic incident involving a third party. The system becomes a high-stakes game of cat and mouse on the open sea. And while that drama unfolds, the underlying cost continues to rise. Naval presence is expensive. Extended deployments strain budgets. Taxpayers absorb the burden. Deficits widen. The price of global policing becomes more visible even as its necessity is rarely questioned. From Beijing's perspective, this observation is critical. The United States can enforce these blockades, but it does so at enormous financial and political cost. High deficits are not abstract. They translate into higher interest rates, heavier debt servicing, and growing dependence on capital markets. And capital markets are sensitive to confidence. This is where the logic begins to turn. If Washington insists on using physical power to control supply chains, it exposes itself financially. That exposure is the opening. Because currency and capital markets do not require fleets. They require participation. They can shift far faster than any naval buildup, and they operate continuously without headlines or declarations. The tightening of Venezuelan oil flows was not an isolated pressure point. It was the first visible stress fracture in a much larger structure. China absorbed the signal, and it recalibrated. This recalibration did not take the form of protest or escalation. It took the form of diagnosis. Where is the vulnerability? Physical supply routes policed by a strategic rival. How is that vulnerability mitigated? Not overnight. Stockpiling helps only temporarily. Diversification raises costs. The deeper solution lies elsewhere. If you cannot immediately secure the physical flow, you apply pressure where your opponent is exposed. And that exposure is not at sea. It is in balance sheets, in deficits, in currency credibility, in the confidence that underpins global capital flows. This is the transition point, the moment where regional enforcement action quietly transforms into something far more consequential. What began as pressure on a sanctioned producer becomes a structural collision with a much larger power. The oil did not just stop moving, it revealed who depends on whom, and once that dependence is exposed, adaptation becomes inevitable. Venezuela was never the prize. It was the lever. The real contest was always elsewhere. And this is where part one ends. Not with confrontation, but with realization. Because once a major economy recognizes that its core inputs can be throttled indirectly, it does not respond emotionally, it responds structurally. The next phase does not unfold at ports or in shipping lanes. It unfolds in markets, currencies, and the quiet recalibration of global finance. That shift is already underway. The moment the realization sets in, the conflict changes shape. Not visibly, not dramatically, but decisively. Once Beijing absorbs the lesson that physical supply chains can be constricted without warning, the priority is no longer to defend a single route or a single supplier. The priority becomes insulation. And insulation at this level does not begin with ships or bases. It begins with finance. This is where most observers lose the thread. They continue watching tankers, inspections, and naval movements, assuming that any response must occur in the same theater. But that assumption misunderstands how leverage actually works. Physical power is slow, expensive, and visible. Financial power is fast, cumulative, and largely invisible until its effects are already embedded in the system. China understands this distinction deeply. It has spent years preparing for precisely this kind of transition. Currency is not a technical variable in this context. It is a strategic instrument. And when physical access becomes conditional, currency becomes decisive. China does not announce a currency war. It never needs to. Instead, it alters the boundaries of what it is willing to tolerate. For years, Beijing tightly managed its currency to support exports, absorbing criticism from Washington about manipulation and unfair advantage. That posture made sense in an environment where growth depended on price, competitiveness, and access was assumed. But when access itself becomes a variable, the calculus shifts. Cheap exports lose strategic value when supply chains can be interrupted at will. What matters then is resilience, capital attraction, and leverage over the financial system that underwrites global trade. This is why the signal of a stronger Chinese currency matters so much. It is not about nationalism or pride. It is about repositioning within the global system. Allowing the currency to appreciate does several things simultaneously. First, it alters capital flows. A firmer currency makes Chinese assets more attractive to global investors, especially at a moment when the United States is issuing record amounts of debt to finance deficits inflated by enforcement, military commitments, and interest costs. Capital is opportunistic. It moves toward yield, stability, and credibility. When investors see a state willing to defend its currency and absorb inflows, they respond. Second, currency strength reframes political narratives. For years, Washington accused Beijing of exporting deflation through artificially cheap goods. Appreciation blunts that argument. It allows China to claim that market forces are being respected, weakening the justification for tariffs and trade barriers among U.S. allies. This matters because financial alignment depends as much on legitimacy as it does on returns. Third, a stronger currency increases purchasing power abroad. Real assets become cheaper. Energy projects, mining operations, infrastructure, logistics hubs, and strategic commodities can be acquired more efficiently. In a world where tangible assets are increasingly scarce and politically sensitive, this matters enormously. Currency is not just a medium of exchange, it is a claim on future resources. The United States, by contrast, finds itself constrained by the structure of its own power. Maintaining global enforcement requires continuous borrowing. Borrowing increases debt supply. Increased supply demands higher yields. Higher yields raise debt servicing costs. Those costs feed back into deficits, creating a loop that markets eventually notice. This does not mean collapse. It means sensitivity. It means fragility at the margin. This is the asymmetry China exploits. It does not need the dollar to fail. It only needs alternatives to become marginally more attractive. A few percentage points of global reserves reallocated. A gradual rise in trade settled outside the dollar. Increased foreign participation in Chinese bond markets. Each of these shifts is small in isolation. Together, they alter the landscape. The Venezuelan oil disruption accelerates this process by introducing a new category of risk into the system. It reminds investors that geopolitical enforcement is not confined to peripheral markets. It sits at the core of global trade. When access to energy can be weaponized, dollar-denominated assets tied to global flows carry an implicit political risk that was previously discounted. China's response offers a counter-narrative, stability through diversification, not confrontation, but optionality. This is why the move feels understated. There is no dramatic revaluation, no emergency announcement, just a sequence of policy cues, regulatory allowances, and rhetorical shifts that collectively tell the market a story. And markets respond to stories when they are backed by credibility. As the currency firms, capital tests the waters. Inflows increase, domestic markets respond. Equities outperform peers, bonds attract interest. Each development reinforces the others, creating a feedback loop. This is not accidental. It is the flywheel Beijing has been trying to spin, slowly, deliberately, without forcing the issue. The United States watches this unfold from a difficult position. Countering currency dynamics is far harder than intercepting ships. You cannot sanction confidence without destabilizing your own system. You can raise rates, but that deepens fiscal strain. You can threaten tariffs, but that feeds inflation and political backlash. The tools available are blunt, and their side effects are severe. This asymmetry favors patience. China can afford patience. It can absorb domestic adjustments while benefiting from international inflows. The United States, by contrast, must constantly manage immediate consequences, balancing enforcement with market stability, signaling strength while avoiding panic. The Venezuelan episode did not create this imbalance. It exposed it. As currency dynamics begin to assert themselves, the effects spread outward in ways that initially seem disconnected. Currency movements ripple through portfolios, trade settlements, and policy decisions simultaneously. Higher U.S. yields, which once signaled strength, begin to carry a second interpretation. They reflect not just opportunity, but strain. The cost of servicing expanding deficits. Deficits inflated in part by the very actions used to project power abroad. This creates a paradox. The United States must offer higher returns to attract capital, but those higher returns increase the burden on its own system. China's strategy exploits this tension without naming it. As its assets become more attractive, global capital is presented with a choice that did not meaningfully exist before. Stay anchored to a system increasingly dependent on debt expansion, or diversify into a market signaling long-term strategic intent. Even modest reallocations matter. Pension funds, sovereign wealth funds, and large institutions do not need to abandon the dollar to shift outcomes. A few percentage points redirected can move exchange rates, influence yields, and alter policy responses. This is where the currency war intersects with the real economy. A stronger Chinese currency reduces import costs, easing domestic inflation and freeing capacity for investment. It increases the purchasing power of Chinese firms abroad. Strategic acquisitions become easier. Long-term resource contracts become more affordable. Gold, in particular, takes on renewed importance. With a strengthening currency, accumulating physical assets outside the financial system becomes increasingly attractive. Gold is not just a hedge, it is a signal. It represents a desire to reduce reliance on paper claims and external enforcement. Accumulation sends a message, quietly, consistently, without confrontation. It reinforces the broader narrative that financial autonomy matters as much as trade access. Meanwhile, the United States navigates the downstream effects of its own escalation. Oil disruptions feed into price volatility. Inflation expectations remain sticky. The central bank is forced to balance competing objectives, support markets or contain prices, strengthen the dollar or protect growth. Each choice carries costs. Confidence erodes gradually, not in headlines, but in assumptions. The Venezuelan episode accelerates this erosion by highlighting the feedback loop between geopolitical enforcement and financial fragility. Every action taken to control supply chains feeds back into the balance sheet of the state. China's approach, by contrast, appears disciplined. It allows trends to develop organically. Appreciation is framed as market-driven, not imposed. That framing matters. It reduces resistance. It reassures partners. It encourages participation. As performance improves relative to peers, the narrative reinforces itself. Success attracts capital. Capital reinforces success. Trade settlement practices begin to evolve. Companies exposed to currency volatility seek insulation. Bilateral agreements denominated in alternative currencies become more attractive. This does not require a grand announcement. It happens contract by contract, transaction by transaction. Over time, the cumulative effect is significant. The dollar does not disappear. Its role does not collapse. But its exclusivity diminishes. And exclusivity is the source of leverage. Sanctions are effective when there is no alternative. Enforcement is powerful when access is binary. As options multiply, pressure loses potency. This is the irony at the heart of the situation. The tools used to demonstrate dominance are accelerating the search for alternatives. The oil squeeze was meant to signal control. Instead, it highlighted dependence. Dependence on debt. Dependence on capital inflows. Dependence on confidence. China does not seek to break the system outright. It seeks to rebalance it. To create a multipolar financial environment where no single actor can dictate terms unilaterally. That goal does not require confrontation. It requires persistence. For investors, this environment is volatile and opportunistic. Old correlations weaken. Safe havens are redefined. For policymakers, the challenge is greater. Managing a transition of this magnitude without triggering instability requires precision. The United States must decide whether to double down on enforcement, accepting rising costs, or adapt to a world where influence is shared. China appears prepared for the long game. Currency wars are not won quickly. They are won through credibility, accumulation, and time. Each policy signal contributes. Each market response compounds. Oil was the catalyst. Currency is the mechanism. And confidence is the battlefield. By the time the outcome is obvious, the shift will already be embedded, not in speeches or treaties, but in portfolios, reserves, and expectations. The most consequential battles ahead will not be fought at sea. They will be measured in basis points, allocation decisions, and trust. And once those begin to move, they rarely move back. What just happened is being explained in the wrong direction. Most coverage treats it as a regional enforcement action, a familiar story involving sanctions, maritime pressure, and a politically isolated regime. That framing is comforting because it keeps the implications small. It suggests containment. It suggests control. But that interpretation collapses the moment you step back and ask a more uncomfortable question. Who actually absorbs the shock when a sanctioned producer is quietly removed from the global system? Because this was never about Venezuela in isolation. It was never about Maduro as an individual actor. And it was certainly never about sending a message to Caracas. What unfolded was a triggering event, not the main act. A spark that released pressure inside a system that had been quietly tightening for years. The mistake most observers are making is assuming the story ends at the coastline. It doesn't. The shock didn't stop in the Caribbean. It moved outward, following the logic of energy, logistics, and dependency. And when you trace that path honestly, it leads somewhere far more consequential. The moment the United States escalated pressure on Venezuelan oil flows, it pulled on a lever that does not operate locally. Oil is not a national commodity. It is a system input. When supply is disrupted anywhere, the effects propagate through shipping schedules, insurance markets, refinery planning, futures pricing, and geopolitical alignment simultaneously. This is not theory. It is how modern economies function. Energy is the bloodstream, and interference in one artery is felt far from the point of compression. What makes this particular event different is not the method. The United States has used sanctions, inspections, and naval presence many times before. What makes it different is the context into which it landed. Venezuela, despite its economic collapse and political isolation, still occupies a specific and unusually sensitive position inside the global energy network, not because of volume alone, but because of who depends on its output and under what conditions. For years, Venezuelan crude has moved through the system at steep discounts, unattractive to Western buyers, but highly valuable to a country willing to absorb political risk in exchange for cheap energy. That country is China, not as a symbolic partner, but as a strategic planner. Chinese refiners integrated Venezuelan oil into long-term cost structures, margin calculations, and supply forecasts. This was not opportunistic buying. It was structural dependence, built gradually and deliberately. And when Washington tightened its grip on Venezuelan waters, it did not merely constrain a sanctioned regime. It disrupted a discounted energy stream feeding a much larger industrial machine. That is where the situation crosses from regional enforcement into global confrontation. The public narrative talks about compliance, seizures, and regime pressure. But beneath that narrative is a consistent pattern that repeats across decades of geopolitics. When the United States wants leverage, it does not start with tanks. It starts with choke points, shipping lanes, insurance underwriting, port access, compliance regimes, naval signaling. These are not dramatic tools, but they are devastatingly effective. Control the movement of energy, and you control the tempo of entire economies. You don't need to stop every tanker. You only need to inject enough uncertainty to make participation irrational. That is exactly what happened here. The moment Washington signaled heightened scrutiny over Venezuelan exports, the mechanics of global shipping reacted automatically. Insurers reassessed risk. Premiums rose. Coverage became conditional. Traders recalculated timelines. Charterers built delays into contracts. For large crude carriers operating on thin margins, time is not an abstraction. Each day of delay translates into tens of thousands of dollars in losses. Multiply that across inspections, rerouting, and idle waiting, and the economics collapse quickly. This is how modern economic warfare is conducted. Quietly, procedurally, without spectacle. Ships turn away before they are stopped. Contracts are canceled before penalties are triggered. Coverage is withdrawn without public announcement. What appears on paper as a limited enforcement action becomes, in practice, a market-wide refusal to engage. No blockade is formally declared, yet the effect is indistinguishable from one. Inside Venezuela, the consequences were immediate. Oil production fell sharply, not because reserves vanished, but because storage filled. Oil cannot be exported if it cannot leave. And when exports stall, tanks fill. When tanks fill, wells must slow or shut. This is not political pressure, it is physics. The system has no flexibility. By targeting exit points rather than infrastructure, maximum pressure is applied with minimal direct intervention. But the real effects did not remain inside Venezuela for long. Every barrel that failed to leave its ports was a barrel that failed to arrive somewhere else, and that absence mattered far more in Beijing than it did in Washington. Chinese refiners felt the disruption almost immediately. Margins tightened. Input costs rose. Planning assumptions were invalidated. Venezuelan crude is not easily substituted. It is heavy, sulfurous, and requires specific refinery configurations. Systems optimized for it cannot simply switch to lighter grades without efficiency losses. When systems reach this stage, survival no longer depends on strength alone. It depends on compatibility. The structures that endure are not necessarily the most powerful, but the most adaptable. They are the ones that absorb volatility without requiring constant assertion. And that distinction matters now more than at any point in recent memory. The first assumption to fade is permanence. Not the permanence of institutions, but the permanence of arrangements. Trade routes, settlement norms, reserve allocations, alliance commitments. None disappear, but none remain fixed. They become adjustable, contingent, subject to revision. This is the defining feature of the new environment. Stability no longer comes from uniformity. It comes from flexibility. What stabilizes first is behavior, not architecture. Actors stop assuming frictionless access. They price disruption as normal rather than exceptional. Corporations build redundancy not because it is efficient, but because it is survivable. Governments tolerate higher costs in exchange for reduced exposure. Markets adjust expectations downward, not in panic, but in realism. This adjustment is painful, but it is also clarifying. The world does not deglobalize, it reconfigures. What survives is what can operate across multiple systems simultaneously. Currencies that can function both as settlement tools and reserve assets. Financial institutions that can intermediate across jurisdictions without depending on a single regulatory anchor. Supply chains that can reroute without collapsing margins entirely. These structures gain value precisely because they do not require certainty to function. This is why the end state is not fragmentation, but layering. Multiple currencies coexist. Multiple settlement channels operate in parallel. Multiple security guarantees overlap imperfectly. Redundancy replaces optimization as the guiding principle. The system becomes less efficient, but more resilient. That trade-off defines the next era. The dollar survives because it adapts, not because it dominates. Its role shifts from unquestioned default to preferred option among several credible alternatives. That distinction matters. Preference can be lost temporarily and regained. Default, once broken, cannot. China's currency does not need to replace the dollar to succeed. It only needs to be usable, trusted, and liquid enough to serve as an alternative when pressure rises. Each successful transaction builds confidence. Each cycle without disruption normalizes its role. Over time, familiarity does the work that force never could. Gold survives because it does not belong to any system. It remains the asset of last resort not because it generates yield, but because it generates certainty. In an environment where paper claims multiply and enforcement becomes politicized, physical scarcity regains relevance. This does not signal regression. It signals hedging against complexity. What replaces the old assumption of dominance is not a new hegemon, but a new mindset. Risk is no longer something to be diversified away entirely. It is something to be managed continuously. Optionality becomes more valuable than scale. Liquidity becomes more situational. Trust becomes segmented rather than universal. These are not failures of the system. They are adaptations to its constraints. The most important replacement, however, is psychological. For decades, the global system operated on the belief that enforcement could be applied without meaningful feedback. That belief no longer holds. Every action now carries visible second and third order effects. Every assertion of control invites a response, not necessarily in kind, but in structure. This awareness changes decision-making. Power becomes more cautious, not weaker. States learn that influence is more durable when it is exercised indirectly. Markets learn that stability is contextual, not absolute. Investors learn that concentration carries hidden risks. None of this leads to paralysis. It leads to recalibration. The danger in this phase is nostalgia, the temptation to restore a system that no longer fits the environment. Attempts to reassert exclusivity where optionality has already emerged create friction rather than compliance. They accelerate the very dynamics they seek to reverse. The opportunity lies in acceptance. Acceptance that the system has changed, that leverage is shared, that enforcement has limits, that resilience requires compromise. Those who internalize this early shape the rules of the next phase. Those who resist it spend resources defending assumptions that no longer hold. This is not decline, it is transition. The oil squeeze that triggered this sequence was not the cause. It was the catalyst that exposed the structure beneath the surface. The currency shifts that followed were not retaliation. They were adjustment. The rebalancing now visible is not collapse. It is redistribution of influence across domains. The system will stabilize again. It always does. But it will stabilize around different expectations, different norms, different tolerances for risk and cost. The actors that emerge strongest will not be those who controlled the most, but those who adapted fastest without forcing the system to break. Quiet credibility will outperform loud dominance. Patience will outperform pressure. And when this phase is eventually described in hindsight, it will not be remembered for a single crisis or confrontation. It will be remembered as the moment when the world stopped assuming that power could be exercised without consequence and began pricing the cost of influence more honestly. That is what replaces the old order, not a new empire, not a sudden collapse, but a system that finally acknowledges its own limits and reorganizes around them. Once the transition matures, something subtle but decisive occurs. Power stops trying to look absolute. It no longer announces itself through dominance displays or sweeping enforcement. Instead, it becomes selective, contextual, economical. This is not weakness. It is efficiency born from constraint. The world that emerges after illusion is not calmer, but it is clearer. Actors understand where pressure works and where it backfires. They recognize which tools scale and which exhaust themselves. Influence is no longer measured by how often it is used, but by how rarely it must be used. The ability to shape outcomes quietly becomes more valuable than the ability to impose outcomes visibly. This is the defining shift. In this environment, leverage migrates toward those who control coordination rather than coercion. Payment systems that function across blocks, financial infrastructure that interoperates without demanding allegiance, energy arrangements that tolerate redundancy without collapse. These are not dramatic achievements, they are boring. And boring is precisely what makes them powerful. Stability returns not because conflict disappears, but because escalation becomes inefficient. Every major actor internalizes a shared constraint. Pushing too hard produces diminishing returns. The system now contains enough alternatives that pressure leaks rather than concentrates. Sanctions still exist, but they resemble friction more than force. Markets still react, but reactions are distributed rather than synchronized. Shocks dissipate instead of cascading. This is what a mature multipolar system looks like. The United States remains central, but not solitary. Its strength lies in depth rather than exclusivity. Its markets remain liquid. Its institutions remain influential. But influence now depends on cooperation as much as command. Leadership becomes more negotiated, less assumed. China consolidates its position not as a challenger, but as a fixture. Its currency circulates where trust has been earned. Its markets integrate where transparency improves. Its influence grows not because it replaces an anchor, but because it becomes one of several. That distinction matters. Anchors stabilize systems, hegemons strain them. Other actors gain relevance precisely because the system allows it. Middle powers coordinate. Regional hubs specialize. Smaller states exercise agency by choosing alignment tactically rather than permanently. This is not fragmentation, it is differentiation. The most profound change, however, occurs in expectations. Markets stop assuming rescue. Governments stop assuming compliance. Corporations stop assuming continuity. Risk is priced honestly. Growth is pursued with buffers. Efficiency yields ground to durability. This lowers peak performance but raises survival odds. The system becomes less spectacular and more sustainable. This is why the final outcome feels anticlimactic. There is no moment where the old order falls, no ceremony where the new one is declared. There is simply a gradual realization that certain moves no longer work the way they used to. That leverage must be applied differently. That power has a cost curve that steepens faster than expected. Those who recognize this early prosper quietly. Those who deny it expend resources proving a point no longer disputed. The lesson embedded in the entire sequence is not about oil or currency or sanctions. It is about feedback. Systems that ignore feedback accumulate fragility. Systems that adapt to it regain balance. Power that treats consequences as external eventually encounters them internally. This is the equilibrium now forming. It is imperfect. It is volatile. But it is also more honest. It acknowledges limits rather than denying them. It distributes responsibility rather than concentrating blame. It forces actors to choose restraint, not because they are weaker, but because restraint now outperforms excess. The illusion that power could be exercised without cost has dissolved. In its place is something more durable, a system where influence must be maintained, not assumed, where dominance is contextual, not universal, where control is partial, and therefore more stable. That is what remains after illusion, not peace, not dominance, but balance enforced by reality rather than belief. And once reality becomes the arbiter, the system, however strained, begins to hold. At this stage, the system no longer responds primarily to policy. It responds to memory, not institutional memory recorded in documents, but behavioral memory embedded in markets, contracts, and expectations. What actors experienced during the transition becomes encoded into how they behave afterward. This is how systems learn. And once a system learns, it resists being reset. The most important outcome of this entire sequence is not who gained or lost influence in the short term. It is that uncertainty has been normalized. Access is no longer assumed. Liquidity is no longer unconditional. Neutrality is no longer passive. These are not ideological changes. They are practical ones. Participants begin acting as if pressure will return, even when it does not. This is the quiet discipline that emerges after stress. Corporations maintain redundancy even when costs fall. Central banks hold diversified reserves even when volatility subsides. States preserve optionality even when relations improve. The memory of vulnerability lingers longer than the vulnerability itself. This is why reversals become difficult. Even if enforcement eases, even if sanctions unwind, even if diplomacy stabilizes relations, the behavioral adjustments remain. The system does not forget what it learned about leverage, exposure, and dependency. Trust, once segmented, rarely recombines fully. This is the long shadow of structural pressure. What follows is a world where friction is priced continuously rather than episodically, where markets react less violently but more persistently, where shocks are absorbed unevenly instead of catastrophically. The absence of crisis does not imply the return of simplicity. Instead, complexity becomes the baseline. Power in this environment is less about forcing alignment and more about shaping incentives. Influence is exercised through architecture rather than action. Those who design the rails matter more than those who run the trains. Those who define standards quietly outlast those who enforce rules loudly. This is why the most powerful moves ahead will look administrative, not strategic. Payment interoperability agreements, regulatory harmonization, data standards, settlement frameworks, insurance backstops. These are the mechanisms that quietly determine who can trade, who can hedge, and who can absorb shocks. They rarely make headlines. They shape outcomes for decades. The system rewards those who understand this shift, not because they dominate, but because they fit. Actors who insist on restoring old certainties find themselves spending more resources to achieve smaller effects. Actors who accept partial control conserve strength. Over time, this differential compounds. Not explosively, but persistently. This is how advantage accrues in mature systems. The final irony is that the system becomes more stable precisely because no one fully trusts it. That mistrust produces buffers. Buffers produce resilience. Resilience reduces panic. The absence of panic prevents collapse. It is an equilibrium built on caution rather than confidence. This is not the world many planned for. It is not the world institutions were designed to manage. But it is the world that emerges when leverage is contested and feedback is unavoidable. The sequence that began with an oil squeeze ends with a behavioral shift. Not dramatic, not visible, but decisive. The system internalizes the lesson that power has costs, that access is conditional, and that adaptation outperforms assertion. Once that lesson is learned, it does not need to be repeated. The next crisis will look different. The next pressure point will emerge elsewhere. But it will be met by a system already conditioned to absorb, reroute, and adjust rather than freeze. That is the final state. Not a resolution, not a victory, but a system that has been hardened by exposure and reshaped by constraint. And in that system, the most important force is no longer dominance, it is memory. If this analysis shifted how you see the system, that was the point. These dynamics don't announce themselves, they reveal themselves over time. If you want to follow how power, markets, and leverage actually evolve, stay with the channel. Subscribe to keep track of the signals that matter before they become obvious. And if this added clarity, share it with someone who's still watching the headlines,